As we all know, freight companies like Mainfreight and Freightways have been going up wildly as demand assisted by COVID-19 has driven up their performance. But what about higher margin software companies trying to take a ride along in this market? Eroad, a fleet management solution and tracking company that has been delivering on revenue year on year, quarter by quarter, and even with COVID-19, still managed to increase the number of contracted units on the road by 5% between April and September last year, with the global freight and logistics industry forecasted to grow at an average of 5% yearly due to the trend in which we as consumers buy goods through online shopping. Logistics and transport companies will need to adapt rapidly to this changing environment. So, is Eroad in a position where it can potentially see growth as transportation companies will need to have a highly efficient network and provide high levels of accuracy in order to cope with this increase in demand and be competitive in the market? Hey, what's up guys, welcome to another video. With the rise in stock prices of transportation companies, we thought it might be a good idea to go over this company which has been overshadowed by other stocks. As always, we try to provide reviews on stocks that have future prospects and fly under the radar, so make sure to smash that like button to show your support and subscribe if you haven't so already. But for now, let's jump right into it. So as always, a little bit about the company. As mentioned before, Eroad is a fleet management solution that also provides tracking. Eroad captures valuable data through fitted hardware and vehicles that can provide valuable insights, accuracy, and assurance for customers. Eroad is a SaaS solution, service as a software, which is a subscription-based model where customers pay a monthly fee per vehicle/unit. This model is very scalable as the customers can pay for more features on an as-needed basis. Eroad's monthly SaaS average revenue per unit has been increasing year on year, which now sits at $58.8, which indicates that customers are purchasing more and more features and that the company's direction in terms of product releases have been effective. In order to understand the business, we need to understand what the customer value is in Eroad's product. Out of the many features, some of the value propositions for customers are being able to fully get a bird's eye view of vehicle operations and tracking driver efficiency and safety by capturing speed data. Additionally, the driver is ranked on performance, which enhances driving behavior and promotes safer journeys, which in New Zealand, companies can get insurance premium benefit if they can prove that their drivers are among the top performers. Being able to capture data right down to this granular level helps the customer make important business decisions, aids in cost saving, gives assurance, and builds a network for every vehicle to be connected on.
So how has this service grown over the years? Since the year Eroad went public in 2014, Eroad grew its revenue every year without a fail, with an astounding average compounded annual growth rate of 42% for the last 6 years, from just 10 million to 81 million. Although during this time Eroad was a loss-making company, this was to accelerate growth, and this shows the scalability of revenue growth they are capable of. And even the pandemic wasn't able to put a stop to their growth. Although COVID did manage to slow the growth down, Eroad was still able to add 5,700 units between April and September last year. As a result, their first half of FY21 revenue was $45 million, which is up 19% from $38 million, which they did during the first half of FY2020. Now, geographically speaking, where do Eroad's customers lay? Number of units mainly lay in New Zealand and North America. The total number of units as at 30th of September sits at 122,000 units, where 84,000 is contracted from New Zealand, 35,000 from North America, and only 2,000 from Australia. Although the number of units from Australia sounds small, this is because the company has only recently started expanding in Australia, where the units are steadily increasing. And Eroad has said, in Australia, growth during the next 2 years will come predominantly from an enterprise pipeline of 15 to 20,000 vehicles, which would be a nice growth if it becomes a reality. Although New Zealand and North America is an established market for Eroad, they managed to grow their New Zealand units by 5% and North American units by 4% just during the first half of FY21. In terms of the outlook from now on, Eroad expects the second half of FY21's revenue to be slightly higher than the first half, which means we could expect over $90 million in revenue for FY21. For FY22, the company expects the revenue to be stronger again, but not at the same level experienced in FY20, which was 32%. And until FY22, they expect the EBITDA margin to be maintained to accelerate new product delivery, but improving at the end of FY22. So this seems like the company doesn't have their eyes on making profits yet and is solely focused on growing. Therefore, we probably shouldn't expect any significant profit for the next couple of years. At the current share price of $4.99, Eroad's market cap valuation is at $408 million. This means if we were to take the $90 million as revenue from what we derived earlier, and EBITDA of $30 million for FY21, as the company guided EBITDA to be similar to the first half's figure, which was $15 million. The forward enterprise value to revenue multiple and enterprise value to EBITDA multiple will be 4.3 and 12.8 respectively, which if we compare it to other tech companies in New Zealand, Eroad's multiple is quite lower for a company that's been showing consistent growth. Now you might be wondering, the growth so far has been good and all, but how much more could they do? Compared to the current size of Eroad, the total addressable market for Eroad to capture is huge. According to them, across the 3 regions they operate in, there are 18 million medium to heavy vehicles, meaning Eroad currently only has 0.7% of the total addressable market. However, this is where the risk comes in. As you probably would have guessed, in this potentially huge market, Eroad isn't the only company that provides fleet management solutions. With just a quick Google search, you can find an enormous amount of competitors in this space. This kind of service doesn't really have a high barrier to entry. Unlike developing an electric vehicle or a space vehicle from scratch, fleet management software is much easier to develop, hence this space can become more competitive.
Eroad looks like it won't be making any meaningful profit anytime soon, as the company is focusing on growth. The company has mentioned a goal of having 250,000 units connected. Given the track record of consistent growth, the expansion into Australia, and the recent successful capital raising of $53 million to accelerate growth strategies, the milestone might not be far away. Having said this though, with the latest announcement of the quarterly operational update, their share price dropped 6% last Friday. In their announcement, they reported that Eroad grew by 1,284 units, which is about 1% growth, but in North America segment, they had an overall decline of 39 units due to the challenges faced by the second wave of COVID-19 in America and the uncertainty around the US presidential election, which is not a very positive change that explains the 6% sell-off. However, Eroad stated that they remain confident with the guidance they provided on 26th of November last year. So that was our take on Eroad. What are your thoughts on this company? Do you see this company as being part of your portfolio? Do let us know. And as always, make sure to smash that like button and subscribe button if you haven't so already. We'll catch you next time.